of Julian Gordon multifamily movement. And so there weren't any market meetups in this general Bay area. So San Francisco, Oakland, there was a market meetup in Sacramento. And so I decided, hey, I want to convene folks, San Francisco, Oakland, Bay Area, to network, to come together, support each other in our learnings, offer opportunities for each other to expand learnings. And so Ray allowed me to bring him along the journey of being co-market leaders for the multifamily movement. And so I just wanted to give a shout out to Julian Gordon. We have quite a few folks who are in the movement on this call. So Julian Gordon, biggest focus is financial freedom. And so he created a curriculum, and it's so mind shifting, like transformation. It offers folks to go from one level to the next in their understanding of how to purchase multifamily property the right way. And so I just needed to give a shout out to him and a plug that he will also be in the Bay Area in May. And so you all will be getting some information about the paid for purpose tour that he's facilitating, which is specific to what you were created by the creator to do in this earth realm and to get paid for fulfilling your purpose. And so I just wanted to drop that. And so then Ray and I decided we want to add the Black Ops work in collaboration with the multifamily movement. The Black Ops, we focusing on property acquisition and management. We're focused on financial literacy, goal setting, real estate acquisition. So we wanted to merge the two. And that's how we came together, just to give a little bit of background. And wanted to also set our intentions for this meeting. And I know when we come together, our minds can be in so many different places, but I just want to take the time to ground us and to allow ourselves to align with each other, to set some goals that we would allow ourselves to come into a place to receive new, innovative, and creative ideas, allow ourselves to network in a new way, and to create sustainable wealth, not only for ourselves, for our generations to come, and for the community at whole. So that's my setting the intentions for this morning. I'm happy that you all are here. I'm looking forward to the transformative experiences that'll take place under the helm of Nikki, under the helm of Paula, and under the helm of William. And so we are here to be a support, to add value, and to move forward in a positive direction in every area of our life. So I'm happy to be here.
Thank you for that. Oh man, that spiritual uplift right there. That's a good way to get started. Truly grateful to have you on my team and truly grateful to have you all and be amongst you all. And so with that, I want to get started and
Okay.
and
All right.
introduce you. Oh, did you want to say something, Marcel, real quick?
I was getting set up. Hello, you guys. Thanks for your patience. Ray, again, thank you for the gracious invitations, brother. It's always a pleasure. And I'm here to network and learn more about this initiative and really collaborate and just really in this space, just be a student of what the purpose is and, really intervene where it's appropriate or collaborate where it's appropriate. So again, thanks for the invite, Ray. And it's a pleasure meeting you all. I'm looking forward to this resetting as we go into this meeting.
Awesome. Awesome. Thank you for that, Brother Davis. Uh, so with that spiritual kickoff, I want to bring us and introduce some, oh my God, some wave movers. And I'm glad that they cover the gamut, right? The spectrum of what we're talking about. So we're talking about wealth accumulation, wealth building, and we're talking about first time home buyer ownership and financing. And so I'm going to lead with our ladies who are on the panel. First, I want to briefly introduce Miss Nikki Beasley. I happen to be under her tutelage and under her stewardship when she's actually ushered me through her emerging developers program to become a developer. So actually, 3 out of the 4 members of Black Ops have been under her tutelage for a while. So see what you've galvanized, Miss Beasley. So Miss Beasley, briefly, if you can kind of tell us who you are, what you do, and what you're offering today.
Well, thank you and appreciate the invitation. And this is why I do what I do, to see you fabulous individuals taking the learning and moving things forward. But my name is Nikki Beasley. I'm the executive director of an organization called Richmond Neighborhood Housing Services. We support Alameda, Contra Costa, Solano County. Our primary focus is to get people into home ownership as a HUD counseling agency. We've been doing the work under my leadership since 2017. The organization has been around since 1981, and we've gotten over 300 first-time home buyers into homes. From that work, we started our emerging developers program because I found pretty quickly coming on board in 2016, we were doing a decent job of getting people qualified for homes, but they couldn't afford to buy anything in the Bay Area. So we became developers looking to figure out how to get ownership opportunities that were affordable to the folks that we care about. And then, working through our emerging developers program. So we're infield small site developers. We run the emerging developers program as well as our HUD counseling agency. And then we're also property managers, landlords of properties in both the city of Oakland and Richmond.
Thank you for that overview, Ms. Beasley. And I know you have a cohort coming up for emerging developers, I think perhaps during the summertime or fall. So y'all be on the lookout, and please share your materials with us, Ms. Beasley, so we can disseminate it out to our audience for folks who are interested in becoming developers and being a part of the network too, more importantly. One of our presenters, Miss Paula Harrell, she's having some audio issues, so we're gonna actually segue to a gentleman that I had the privilege of knowing, working alongside in civic work and community work. And this brother, I don't know if he likes it or not, but I call him McFly because I always see how this brother pays attention to his dress, to how he presents himself. But not only that, more importantly, this brother is has over 2 decades of managing wealth for high net worth individuals and also folks who are working class. And I said, brother, you gotta please come and share your wealth of knowledge with this group. And with that, I want to pass it over to Will. If you can tell us a little bit about yourself, Will Morthel. Thank you, brother. If you could tell us a little bit about yourself and what you can offer here today.
Absolutely. Good morning, everybody. So, yeah, as Ray referenced, I'm a financial advisor, vice president at Morgan Stanley. My two partners and I collectively are responsible for probably a little bit over $1 billion in assets. And so, what we do, generally speaking, is to help our clients navigate essentially the full gamut of their financial complexity. My work specifically, mostly revolves around how my clients intersect with capital markets, with stock, bond, and other investment markets. So I spend a lot of my time looking for actionable items to facilitate wealth creation and efficient wealth transfer and those kinds of things. So so my expertise is not necessarily centered around real estate. So I'm maybe the odd duck in that regard, but I think I might have a nugget or two to share just in the associated with just ideas such as like the psychology of wealth building and some very generalist notions about for Black people in particular, us learning the rules of engagement and some things that we can do to supplement or complement our real estate portfolios as we go through this journey of wealth creation and ultimately wealth transfer. So thanks to the Black Ops team for putting this event together, and I'm thrilled to be a part of it.
Man, thrilled to have you. And don't discount yourself too soon, brother. I know you have some multifamily real estate in your portfolio too. So please add some value from that vantage point and beyond.
Absolutely.
For sure, for sure. So, with your permission, everyone, I can go right into the questions. Miss Beasley still with us? And I think Paula, she's going to be joining us a bit later. So I guess, this is directed to the panel, directed to everyone, because we're about decentralization, but we know you are the experts here, Will and Nikki. And so our first question is regarding, well, if you can kind of speak to and give the overview of like the difference between FHA, VA, and conventional loans and kind of understanding creative financing. Can you break down the key differences between FHA, VA, and conventional multifamily loans?
For me?
That's for
Yes.
you. Yes.
But Will said you can take that one.
That's you.
Yeah, sorry about that.
So, as a buyer, federal government and something called government-sponsored entities have created different programs or different lending options for people to purchase. So, whether you're a first-time home buyer or buying multiple properties, typically the bank or institution that is offering the loan is not using their own money. So they're using GSE, government-sponsored entities like FHA and the others that Ray mentioned. And the reason that banks do that is because if they hold that note under what we would consider a portfolio product, they have to hold that note for 30 years. So their goal is to use a GSE product so that when they book the loan, they can sell it back on the market, get that money, and recycle the money. So going into any type of ownership opportunity, it's important to know, is this a portfolio product or a GSE sponsored product? If it's a portfolio product, that means it's the institution's money. They can do whatever they want, so they can get real innovative and creative because it's their money. If it's a GSE product like FHA, FA, VA, then you know that you have some, boundaries that you can't cross because they're going to sell it to the open market. So FHA is probably one of the oldest programs out there where most buyers used in the early days. And when it's an FHA product, it means that the property has to be almost pristine because FHA does not want individuals going into a property that they're going to have to do a lot of work on. So as you are maybe shopping, you might see FHA approved or not FHA approved. And that's typically letting you know the seller has done all the requirements so that it can be approved by an FHA loan. Or if it says not FHA approved, that means that the buyer's not going to go through all of that. And the reason that that's specific is because you might have a little tear in the carpet or there might need to be paint. It may not qualify. So just know if you're getting an FHA loan, the property has to be in almost perfect condition. VA is for veterans, and many veterans are not taking advantage of the opportunity to be homeowners under that program. Gives them some incentives to where there's no down payment, low interest rate, and really ideally a gift for all of their service to be able to take advantage of that loan. You have USDA, which if you're looking to purchase in rural communities. So hopefully that answers that question.
No, very thorough answer. And I like how you made those distinctions too between the loans. And I'm sure there's more information to be shared, but from a very high level that pretty much pinpoints what I understand the differences to be. So thank you for that, Miss Nikki Beasley. I did want to take an opportunity to introduce our third panelist who's able to join us. I've always had technical difficulties with Zoom, and so thank you for being patient with technology, Paula. But I did want to take the opportunity to introduce Miss Paula Harrell. She's a financier extraordinaire and also serial entrepreneur. Did you want to take a brief opportunity to kind of, I can share the question with you once more, but please introduce yourself briefly, and then if you can speak to the question that was
Sure.
just, thank you.
Thank you. First of all, thank you all so much for having me today. I'm honored to be a part of this panel. And yes, there's some little technical difficulties, but we got over it. So I appreciate your patience. As Ray said, my name is Paula Harrell. I am a San Francisco native. I'm from the Bay Area originally. I got into real estate in the 90s with my father. And it was really because he had some businesses that he closed and he needed somebody to lease out the properties. And I had no idea what I was doing, but my father was one of those, was like, you can figure it out. So that's when I kind of jumped into real estate. And eventually, after seeing how the market worked and buying a few properties of my own and having some challenges with the mortgage lender, I decided that I wanted to become a mortgage lender, and specifically to focus on supporting people of color trying to buy property, because it was It still is sometimes, but it was a significant challenge. So I jumped into the mortgage business in 2003, and I have been serving our community for this entire time. I'm very passionate about home ownership for people of color, and I've taken the position of being the person who gets the hard deals done, because there are always a lot of hard deals, and I like to take those on so that I can make sure that we're getting a seat at the table. So I've been doing mortgages since 2003. I've been investing in property since about the late 90s or so. And I'm just very, very happy to be here and be a part of this panel and share with you everything that I know. So thank you for having me.
Thank you. Thank you so much. And you know what? And I think this is a good segue, Paula. And I did one housekeeping item before I ask that question is I want to let you all know that your questions are important. And if you put your questions in the chat, we're happy to answer these questions at the end of each segment, is if that's okay, if that's the will of my body here, Black Ops and Multifamily Movement, if we can. Malcolm, if you wanted to speak to that, or if anybody else want to speak to that. But my question, real quick, my question to you, Miss Harrell, because Nikki kind of navigated us around like the traditional loan, right? That you would get VA, FHA, conventional loans. Can you talk to us about, speak to like the alternative financing options outside of the traditional loans that investors should consider that probably are lesser known?
Yeah, sure, absolutely. So there's a few different options. There are a lot of different options, but one big one is is seller financing. One thing that people don't know that much about is seller financing, and sometimes it's called seller carryback financing, where somebody who might be in a situation where their income might not be traditional income, they may not be getting regular income, their credit scores might be a little lower, they may not have a significant down payment, they might have some challenges. Sometimes a seller will actually manage the mortgage process. So instead of you having to go to a traditional lender, the seller will say, okay, I will do the loan. I will take on this loan, and you can pay me monthly payments instead of having to go through a traditional lender. The process is usually a little quicker. It's cleaner. The downside is that they may charge a higher interest rate because, it's a risk that they're taking on, holding on to the property, and betting on this person to be able to make the payments, as they said. So the interest rate's probably going to be a little higher. Sometimes, they might actually let you do a lower down payment. It just depends. So seller and buyer will discuss what the plan will be, what the interest rate will be, how much the down payment will be, how long the term will be, all of those different things. They will decide between the two of them. And then they'll enter into this agreement whereby the buyer can get into a property without having to go through the regular processes. There's another way that people can buy property if you're looking at like investment properties. There's something called DSCR loans, and that's debt service coverage ratio loans. So this is for people that, are self-employed and maybe not have consistent income, or, they might actually have great income but do a lot of write-offs. So their tax returns aren't going to show the amount of income that's needed to purchase. This loan is based on the performance of the property rather on the buyer. So they're making sure that the property is being debt serviced so that the rent that's coming in can cover the expenses, the principal, interest, taxes, and insurance. That's bigger focus of what they're looking for in order to get approved for a loan like this. So that's something that, people don't realize. I mean, I just want to give a quick example. I have a friend, I help a lot of my friends, and she inherited a property and they needed to do some work on it. And we got the work done on it, but then she didn't really have enough income to show for herself to be able to do a refinance into a regular loan. So we did a debt service coverage ratio loan. Now, there's also another loan, which is something I did for her in between her inheriting the property and getting the DSCR, which is private money. So people might have heard of private money or hard money lending. And basically, these are investors that are outside of HUD and Fannie Mae and Freddie Mac. They are private investors. They have to follow certain regulations, but not the regulations of traditional lenders. And what they do is kind of similar to DSCR in the sense that they're focused on the collateral. They're focused on the asset. So they still want to see, that you have some assets or you may have some money in the bank or that you have a job, but they're really more concerned with how well does this property perform, how much equity is in the property, because as far as they're concerned, they'll do the loan for you. And then if something goes wrong, they're going to be looking to take that property. Now, the good thing about private money is that it's also very quick. Sometimes they close in 10 days or less, but they do have higher interest rates and they charge points. A lot of times people use this for investment properties, or if they're flipping properties, they're in between properties. Private money is not meant to be a long-term solution, but it's definitely meant for a bridge. So for my friend that I was mentioning, we got private money out so she could fix up the property, and then we refinanced her into a DSCR loan with a lower interest rate. So those are a few alternative loans that you can look at for purchasing property that aren't traditional.
Ooh-wee. I hope y'all been taking notes. I know she had it ran down, and even one of our panelists, Will, I know I saw a question pop up in the chat from you, brother. Please please feel welcome to come off the mute button and voice your question, brother. Because I know I was gonna
Absolutely.
round it out with any perspective that you might be add to the conversation and the questions.
No. I feel like Nikki and Paula, this is a decidedly in that question is decidedly in their wheelhouse. So I'm perfectly content to absorb their knowledge and let them opine. But my question, Paula, was about seller financing. I was wondering how common is it that sellers are willing to take that risk, and what really is their motivation, especially in the environments where the market is strong.
So that's a great question, and nice to meet you, Will. So it's not terribly common. You don't see it all the time, but sometimes you will. Like if there's a seller, for example, I have a buyer that is looking at this property. The seller fixed it up and was getting ready to sell it, and then a lien was placed on the property. So that's called the title being clouded, when some kind of a lien has been placed on the property, like a mechanic's lien, or maybe the seller owes somebody some money and they put a lien on the property. Something happened, and I'm not exactly sure what it is yet, but the title is clouded, so he cannot sell it until that is cleared. And now he's in court dealing with that. But at the same time, he just dumped all this money into this property, and he has a mortgage payment and he has no income. So he's motivated to do something like this because it means that he still will, with seller financing, he still owns the property. He's still on the title, but he's getting the income. It's set up that at a certain time, this property is going to be transferred over to the buyer, and he can have some income to offset, he's bleeding out every month. So he definitely has some motivation. Sometimes people will do it if they want to sell a property, but they don't really need to, like it's not desperate. And they're like, oh, I think I'm going to offload this property. And a real estate agent might, be searching for different people to find out if anybody wants to do this. And a seller might say, hey, you know what? I'd be open to doing that because I'm not in a desperate need to sell a property. And the upside for the seller is, they're getting this extra income every month now, right? They're charging them, they may charge points for this. It doesn't always happen that way, but they are getting income every month, and they have a tax write-off. And so there's some benefit for the seller if they're like, maybe I'll just do this instead of selling the property right now. But it isn't terribly common, but it's there. You can look, people will, especially if you see a property that's been sitting on the market for a really long time, sometimes there's an issue there. Sometimes it's just priced too high, but other times there might be another issue there. And, agents can go start, reaching out to several sellers to see what the issue is and see if they might be open to seller financing. I hope that answers your question.
Absolutely. Thank you.
Welcome.
Masterclass. Thank you for that, Paula. And we're doing good on time. And so, Ms. Beasley, I see your hand up. And I wanted to quickly, and after Ms. Beasley, you asked your question, I have another question that I wanted to follow up with that was in the chat. So, Ms. Beasley, please.
Well, mine was more of a comment, but I do see Martinique's question. So why don't you ask that question and then I can wrap up with the comment.
Absolutely. So, and Martinique, I know she's probably in the background. Again, she's doing, she's supporting her son today. and we support her. Feel free to come off mic, Martinique, or if you want me to stand in, I can.
Yes, so sorry, everybody. Nice to meet everybody. We are back and forth at this NBA math hoops tournament for my son.
I'm
Um,
hoping.
yeah, we're about to watch them play. But yes, Paula, I just had a question. We were gonna get into a seller finance, but I didn't know what an average like interest rate was for the seller to offer us. So I was just curious. And then another question, a follow-up question to that, how do you approach a seller if you want to purchase, or if you're you're the buyer, how do you start that conversation?
Yes. So there isn't really an average interest rate. Generally, like I said, it's going to be a little higher than what the normal interest rates are. I would say that two things in terms of approaching the seller, that would be the real estate agent should definitely be the one that's approaching the seller and figuring out like how to approach the seller with that. Because it's going to be based on some things and then also, like I said, it generally, if it's a strong market, like Will was asking, it's a strong market and this is a hot buy and it can go pretty quickly, most of those sellers are probably going to say no. But if there's a property that looks like it might be in distress or whatever, then they might be a better option. And then I say, start just a little bit above what the regular interest rates are, and you can negotiate from there. But that's definitely something that'll be decided between buyer and seller. So don't start too high because you don't want them to go up higher. Leave yourself some negotiating room. But yeah, it's definitely negotiable. You're welcome.
Feel free to comment, Ms. Beasley, and I'll answer. I'll ask Jennifer, and then Jennifer, feel free to come off mic too. I didn't talk about that housekeeping item too. If you'd like to come off mic after Ms. Beasley states her comment.
Thank you. So I wanted to also share an example. So RNHS owns some property in West Oakland. It's land, definitely a great development option. And we're considering a seller-backed mortgage, meaning could we help the buyer acquire, because the amount that we want to sell it for is the amount we want to sell it for. But some of our buyers are coming in saying, we really want to buy the property, but we want to wait to get
Can you
entitlements
get
and
some
other.
more water, please?
So we're, looking at ways that we can help the buyer get what we need out of the project. And then also our incentive is at the end of it, we'll also have some money coming in. And I think the, answer to Jennifer's question, as a seller, you really do have the autonomy. It can be 30 years, it can be 15 years, it can be 5 years. So it really is negotiable between both parties. I would also say, to Paula's point, I always believe everything is negotiable as you go into just a traditional mortgage or transaction. They're asking 400, you might say, I'll give you 395. So everything is negotiable. And when you are thinking about getting into those conversations, I always say there's a ceiling and floor. So if you're on the receiving end, the goal is you start at a lower amount. So if you're thinking 5%, you ask for 3% so that you get somewhere in the middle, versus asking for 5, then likely you're going to be higher because everything is negotiable.
And I would love to just jump in. So, one of my major takeaways from this particular segment is that there's always a way. So, if you don't qualify for the traditional financing, there's still a way. And so, coming away from the conversation, I can get a mortgage, I can get a loan, I can get seller financing, I can get what I need in order to facilitate a transaction to purchase property. So I would love to offer that perspective as we move forward, that there's no reason or there's no way that you can be stopped to get to your goal, right? There's nothing that's going to hinder you unless you believe that you're going to be hindered. And so offering some piece of advice, get to a real estate professional who can help you navigate whatever challenges, right? Whatever situations, whatever impending things that seem to stop you. Get with a real estate professional, specifically somebody here in this team, to help you navigate to get to your end goal.
I say, speak that thing.
I just wanted to respond really quickly to Jennifer's question about private money and if the loan terms are the same. So no, generally speaking, they're much shorter. They're definitely not 30 years. I think they like to do, 1 to 3 years, 3 years being the top end of private money. Private money is very flexible though. So if you have, a lot of times if it's like a one year term or 2 year term, and you get to the end of that 2 years and you need a little longer, a lot of times they will extend it for you, but it's short term. It's very short term. And again, the interest rates are going to be higher and you're going to have to pay some points, which is also, they're going to come to you with the amount of points that they want, and then you're going to come back and you can try and negotiate it. Just like Nikki and Lakeisha said, you can always try and negotiate it. I'm always for asking you. Well, I'm always for a closed mouth doesn't get fed. I should put it that way. So if you don't ask, you won't know if you're going to get it or not. So you can negotiate it, but yeah, the terms are a little bit different regarding private money.
I'm gonna be just a little bit. Thank you for that, Paula. This is like opening up so many other channels in my mind that I have to ask this other question. And what actually brought this to mind, Will and I were talking about options, calls, and puts, and I kind of used the analogy of like, well, one to one it with like leasing with the option to buy, right? I don't hear that as often anymore. Are there any scenarios where you would recommend to a client to approach a seller with the lease with the option to buy, right? Because you know that the appreciation is going to be in the future, and you can lock in that, that price. Like, hey, I might give you X amount of dollars for future upside of like 300,000, depending on where you're purchasing.
So yeah, I think that with lease with a lease with an option to buy, in some regards, is similar to seller carry or seller financing, because it's an option for the future. I with lease options, they're not very popular in strong markets either, right? Because the seller's like, I'm ready to sell this right now. So it's the same dynamic in terms of, you can always approach. I mean, you never know what's going on with the seller. So you can always approach and ask and see if they'd be interested or not, which is what I say you should do. Because if you're offering that, that means that that's the only way you think you're going to be able to get into the property right now. So I would say approach and come with the best terms you can, and come in with like a strong portfolio as much as possible. You would have your agent and your lender can help you with this, but you'd want to come in with maybe some references and your whatever assets you might have and your income and a letter, a story why you need this, and laying it out. There are a couple of things though, like there's different levels of lease with options to buy. So some of them, it's like you're coming in with a specific amount that you're going to buy in the future. Some say, okay, we're coming in with a lease option, but in the future, it's going to be based on market value at the time that you're actually going to exercise that option. So you also want to make sure you're getting with an agent that really understands all the various options in that, because you want to make sure you're getting the best one for yourself, right? You don't want to get locked into something that, may not work out in the future. Because also, I mean, it doesn't really happen in the Bay Area, but the values may drop considerably. And now you've given them the option at a much higher price, and the value may not be worth it at that point. And what will happen is you go to buy it, you get the appraisal, and the appraisal is at, $750. And the property is only worth $650, then what? So you have to be very careful with those when you go into them. But I say, always offer it. You never know what people have going on. They might be interested.
Thank you for that. And I did want to kind of bring up, because I know we have varying levels of experience in real estate, and we want to make sure that our lay folks, high tech folks, low tech folks, when it comes to the real estate, can join the conversation and be a part of the conversation. And some terminology that was used, because I know there's terms like points, basis points, and that could be, used interchangeably depending on what we're talking about, which aspect of finance. So what, in the context that you use the word points, and then and Nikki, I definitely want to get to you. I'm not ignoring you. What do you use? What do you mean by points?
So when I was discussing points, I was referring specifically to private money for the most part. And what that means is a point is equal to a percentage of the loan amount. So what private money lenders do is they are going to charge you. I mean, it's not cheap money, put it that way. So they're going to charge you a higher interest rate, but they're also going to charge you something up front to put in their pocket so that they know that you have some skin in the game, and this is how they make their extra money. So it's what they'll do. Say, for example, it's a $700,000 loan. They may say, we're charging 2 points for us to do this loan for you. So that's going to be $14,000. Private money usually charges between 2 and 4 points. It just depends. The lower the loan amount, you usually get higher points because they want to make more money on it. And they charge that, and it comes out of the proceeds of the loan. So when you pay it back, you're paying back the full amount, including the points that were charged for it. So that's what the points are. Yeah. I hope that helps.
Thank you.
Yeah, you're welcome.
Does Jennifer, I hope that answers your question. And if not, please feel free to come off mic or ask for clarification in the chat, whatever mode you want to use for communication. Nikki, I know you had your hand raised, and we're doing pretty good on time. We're supposed to segue. Okay, so Jess says, Jess says she did. Thank you. So thank you for that, Paula.
You're welcome.
We're doing good on time. So yes, Nikki.
So a couple of things come up for me. And I'm a retired banker over 25 years, as well as a licensed professional for a number of years. So I can't go into these conversations without reminding folks that before we start getting into these, sophisticated, dynamic ways of wealth, please be sure that your foundation is secure, meaning that you are demonstrating that you are an aggressive saver, that when life happens, it's not going to shake your whole world, that you can continue to pay the rent while you're trying to buy the property, or while you have 3 properties, you can pay the mortgage because people aren't paying the rent. All those things that come up in these type of models, make sure your foundation is secure. Foundation meaning you have the 6 months to a year, 2 years of reserves. So for when again these things happen, you can continue to do what you're doing, because that really is wealth accumulation. It's not about being rich. I had a young man say many years ago, the difference between being rich and wealthy, you don't go broke. Rich, you go broke.
Mm.
And that's the also the conversation around people who win the lotto. They get a whole bunch of money, and if their practices have not demonstrated they know how to handle money, they'll be right back where they were before they won the lotto. So as you're thinking through all of these, nuances, think about where your foundation is. Are you demonstrating right now that the way that you handle money is serving you well? Then you think about, what really do you have to put into an investment? Because whether it's in real estate, stocks, bonds, mutual bonds, there's always the risk of loss. Can you afford to lose it and still be able to maintain, your day-to-day living? So putting that there, wanting to circle then to the lease options to buy, kind of thinking through where policy can be supported. So there's something called a TOPA, tenants opportunity to purchase. And then there's COPA, community option to purchase. And depending on what areas you've lived in, it has been a ongoing conversation explicitly in Berkeley. I know City of Richmond was also pursuing it. So as your networks are thinking about creative ways of ownership, this is the time to be a good citizen and steward within your local city government to see if you can put some of these things on the table, because that is a formalized method that actually sets the guardrails for a owner of a property and a tenant to be able to come to a conversation of negotiation. The reason that lease options to buy have not been successful is because there's a large administrative end to where if the tenant doesn't keep their agreement, then that agreement can fall apart, meaning the amount that they were putting in, a portion of their rent going toward the acquisition, if they miss a rent payment, or if the landlord's not adequately administrating the information, then what was expected isn't the end result. So this TOPA COPA was designed to really kind of create the formalization of it. But usually it's beneficial if you've had a long-term tenant in a property, which we've been able to assist some long-term tenants, make that conversation real with the landlord, not necessarily a lease option, but just a private, sale between the person who's been living there for a number of years and the owner now being ready to sell.
I'm gonna have to dive into this Topa Copa. I didn't know anything about that. So thank you for dropping those gems and nuggets. So Jennifer, I'm gonna ask that question in just a bit here. We're just a little behind time on the next section, and the next section is it's a good segue. So props to my team for designing these questions. And this is about, because you talked about GSE earlier, and I know GSE, I think that's the same program as the Platinum program, if that's still around, down payment assistance. So the question is, for first-time home buyers programs, like let's talk about NACA HUD 203K, down payment assistance. What first-time home buyer programs allow buyers to enter multifamily investing with low or no money down?
So there's a difference. Your community lending programs, those that are going to lend your first mortgage, will allow you to purchase up to 4 units. Most down payment assistance programs, it's only for that single family home. They're only interested in you becoming the first time home buyer, not really interested in creating an investment. So if you are looking for the down payment assistance, it's likely you won't find it for multifamily, but these community lending programs that were sponsored by FHA and what we talked about earlier does allow you to enter with 3% down, 3.5% down. And the beauty of that also is if those units are occupied, then you can also leverage the rents that have been received to help you qualify. So there is, an opportunity there to be able to upsell because you actually have other income you can use outside of your standard W-2. It's not dollar for dollar. It's usually a percentage of what the rents have been, but typically you may not find an assistance program that's going to be explicit to multifamily.
Thank you. Thank you. Did any of our other panelists, would they like to speak to that question?
Well, one thing I'll say is that with FHA, for example, it's not down payment assistance, but of course it affords you the opportunity to put down a lower down payment. So for FHA, it's 3.5% up to, I think, down to a 580 score. And then if you have like a 500 score, it's down to it's up to 10% down payment that you need to put down. But I'm bringing that up because you can purchase up to 4 units as long as you're living in one of those units, and that'll afford you the opportunity to have the investment component with a lower down payment. Again, it's not a down payment assistance, but it does allow you to do that so that you can have that investment component. And like Nikki said, you can use the income from the other units to help you qualify. So if your W-2 income or your self-employed income doesn't cover the mortgage, they're taking 75% of the rents to be able to add that to your income to qualify.
Awesome.
Paula, what is the maximum size of a FHA loan?
It depends on the county. So all the counties have different loan amount limits. I think right now, if I remember correctly, Alameda County is at 1.2 million, I believe. I have to look at it. I'm not exactly sure, but it's different per county. So if you go on the FHA website or the Fannie Mae website, I should say, you can go and look at all of the loan limits for each county.
And then we can probably follow up and share what we find, because they usually have a page where it lists all the counties and
Right.
the thresholds and the caps or whatever. So I'll note to self, I'll try to follow up and share that with the group amongst other resources. I do have another question here regarding this topic. So what are the most common challenges first-time home buyers face when trying to qualify for assistance programs, and how can they prepare to overcome them?
With our work, what we tend to find is people tend to be in better positions than what they think they are. One of the reasons we started our Changing the Narrative, our Lender Ready program, is because many folks didn't realize you didn't need a 700 credit score or 20% down. So the first obstacle is them not being aware of the resources and ways to get into ownership. Like Lakeisha mentioned, there's lots of ways to do it. It's not the traditional need 20% down or very high credit score. The next thing is credit management, debt to income. Your lender is looking at, can you afford to pay this mortgage? Because due to belief, the lenders don't want the property. They just want to make sure that you can pay whatever the obligation is. So usually it's 43 to 45% debt to income, which means that your current debts, which is your consumer debt, what shows up on your credit report, not your household expenses, but just your consumer debt, dividing that against your income, which is your gross income. You live off your net income, and these are real important, measurements. As long as they don't exceed a certain debt to income ratio, will determine your affordability. But many of our folks, the debt to income is high, meaning that the majority of their debt is in consumer debt, so they have no room to take on a mortgage. So it's really important that people understand what debt management is, meaning making sure that you have enough income that can not only support your consumer debt, but your new mortgage debt. And the other thing is credit score, because they're closely aligned. Here's what I always say. Low credit score doesn't necessarily mean that it's a bad credit score. It just means that maybe you don't have enough credit to stimulate the matrix of what a credit score means. All that may mean is that you find a lender that looks at alternative credit. If you haven't really established credit, they may look at your rental, history. They may look at your utility, or however they can justify that you're a good individual to lend to, based on how you've managed other debt if it's not showing up on your credit report. Lenders also understand situational debt, life, divorce, death, loss of job, because any professional looking at your credit score can tell you exactly when life was happening. Like, what was happening the summer of 2023? Because you can see where things start to fall off. A lender understands situations. What they can't really deal with is behavior. So if you are maxing all your credit and all you're doing is making minimum payments, and there's really nothing to justify why you had to go to a credit card to pay expenses, because again, there was a death, there was a loss, that's a lot harder to contend with. So, the other issue is how debt is being maintained, because at the end of the day, your ability to qualify for any of these type of mortgages is either you have to have income with low debt, or higher income to help offset that debt. So those are the challenges. Debt management is the big factor, as well as individuals not really understanding the different ways they can get into homeownership.
Thank you. I think that's what I mean. What's on the top of, I just heard a statistic that the consumer credit card debt went up by like $1 trillion or something, because there's across the nation, like, folks are finding it hard to manage debt given the rise of the cost of food, cost of goods. And that's a whole can of worms. I don't want to necessarily open it up, but these are factors to consider. And it's good to be able to have a conversation with the underwriters, or at least have an intermediary who you can have a conversation with to provide the narrative behind that. So it's not just a hard no.
Yeah. And if I can just say one more thing on that, yes, life is life and it does require us to do extensions just because it's hard to live. But I, again, would be remiss if I didn't talk about other issues, the trauma of money. We also tend to use money as our alcohol, our cupcakes and cakes. Many of us are out there 2 o'clock in the morning ordering stuff. So we also have to understand what the behaviors are in our systems of understanding what money is, because there's also attachment of trauma around how we get in these situations.
Absolutely.
Yeah, if I could jump in on that topic. Yeah, it's very interesting that you bring up the behavioral dynamic. This is actually an area that I've studied in some detail. So there was a Swedish psychologist, Thorsten Veblen, back 100 years ago. He coined this term called conspicuous consumption, and that really is it references the tendency to spend money on high visibility goods. For us is like clothes, cars, and jewelry. And Recent research has found that Black people tend to spend 30% more on high visibility goods than white folks. And I'm talking about when you compare Black people and white people who make the same money. And what apparently underlies that is this desire to like establish status or image in our communities. In fairness, it's not just about Black people. It's not only Black people who do this. Poor white people do it too. But absolutely, there is definitely a psychological underpinning that we have to reconcile if we're going to be serious as a people about our efforts to build generational wealth. So that's an excellent point, Nikki. And if I might continue, the way that we confront that is really, and the people in this group are starting to do it already, is by changing how we define status. Is status the guy that's in a club popping bottles drippy, or is status the person who's very, the casual multimillionaire who you wouldn't look at and know that this guy is very well off, but who is secure that whatever life throws at him, whatever curveballs life throws at him and his family gonna be okay. And so by like associating with like-minded folks like this who are committed to changing that mindset, building generational wealth, then that I think is a start for taking control of that psychological impediment.
And that's why it was so important for us, and Ray brought this up, to incorporate this shifting of mindset, wealth mindset, the psychology of wealth, the psychology that would ensure success for us. So that's why it was really important that we added this component to all of our meetings, because initially we were focused on content. What are we learning? What are we learning, right? But if we don't understand, to your point, around the ways in which we approach our thinking and our learning and understanding more of what's important rather than what we're seeing with our eye that's in front of us, then the change won't be made. And so moving forward, we're going to continue to afford us this transition in our thinking from the wealth psychology perspective. So we're going to embed, and going back to Nikki's point, the foundation, right? This is the foundation that will allow us to sustain the trajectory of wealth moving forward. So thank you for bringing that up. And Ray, thank you so much for ensuring that we have this piece, because I think that was what was lacking before. Not to say we weren't moving, but there are some paradigm shifts that need to take place in order for us to sustain where we're going. Because to Nikki's point, again, going back to the people who got the millionaire money, they didn't change their perspective. They didn't change their habits. They didn't change the ways in which they approached money. So then they fell back. The same fast way they got that money is the same fast way they lost it.
Absolutely. And y'all talked about it so well, and the whole mentality around money. So this is a long haul, right? This is a marathon. And so to get there, we have to have the right mindset. And that's why the collective wisdom in this group, like I talk about, is we're keeping each other accountable. And we're saying, hey, we got to stick to the script. And these are the principles and values we said to ourselves we were going to abide in. And we're going to build that out even more. And that's why the mentorship component, and that's why that synergy link, that synergy matching link that I shared earlier is so important, so we can keep each other accountable even when we get weak and we're like, man, I see those Gucci shoes, or man, I see that new Maserati, right? And like, hold on. This is what we talked about before. This is what we grounded ourselves in. And we got to stick to the script because it is tempting. We're not saying it's I just admitted someone. We're not saying it's easy, but it's real simple. It's simple, but it ain't easy.
That's right.
Thank you, brother. Now I'm going to segue y'all to our next question, our next segment, and it's more like case study based. So we're going to make it real for our guests and our speakers. So, scenario based question, right? If a buyer has limited cash reserves, what financing options would be best?
I'm sorry, if they have limited cash reserves?
Yes, if they have limited cash reserves. 'Cause I know we talked about NACA,
Mhm.
we talked about some of these other programs. And they might have had, like you talked about, a funeral they had to fund. They might have had, there's a number of things that can happen that'll cause to knock people off balance with their cash reserves. So if they have low cash reserves, what are their options?
So I would say that's where a housing counseling agency really becomes beneficial, meaning finding an agency that's HUD certified that is required to understand all the resources that are out there. Because if you just go into your bank asking for, a loan, they're going to be limited to just what they offer. Some lenders may say we need seasoned money, meaning we need to know that you have 3 to 6 months reserve in your bank and it's been there for a period of time. There's other lenders that said we don't care where the money comes from. It could be mattress money. It just needs to be there by close. So if you are limited in resources, then you can't work with the lender that's going to have you define your money prior to the transaction. So it's really going to be the lender requirement because not all lenders are the same. It's also going to see if those lenders have their internal down payment programs outside of what has already been mentioned. So really is understanding who's offering the money and what their requirements are. And I can't stress enough, yes, we are all very motivated for ownership, but we can't go into believing that you're not going to bring any money into the transaction because we talk a lot about down payment, but there's also closing costs. And many of these programs are not supporting closing costs, just down payments. There are a few that doesn't matter how you use those resources. You can use them either way, but you have to come in with some of the funds to help with the transaction. So usually you're looking at about 6% between closing costs, down payment. And if you can get the 3% covered through one of these programs, you still need to be able to have some cash to get you through closing.
Thank you.
And any Paula, Will, any other perspective that you can add, anything you want to scaffold?
Yeah, I just wanted to make the distinction between like the financing options and so like if your cash, your upfront money is limited, okay, Nikki outlined some ways where you might still be able to get a deal done. Um, in distinction to that, I pose a question of if you don't have the money, if we're talking about multifamily real estate investment, is it a good idea? Because invariably there will come a time when all your units are not going to be occupied. Like for me personally, I think you and I talked about this, Ray. I just went through this thing with my house in SoCal where my tenant hasn't paid rent since last summer sometime. And for California in particular, tenants have so many rights. It was the task of evicting these guys was so arduous. If I didn't have the money to cover my overhead while these guys weren't paying me, I would have been in serious trouble. So separate from the question of can I get the deal done without having my money right, is a question of should I do the deal without having my money right? We have to be like very eyes wide open about at some point, when it works great, but at some point, if we're committed to this strategy for the long term, at some point, it's going to rain, meaning that, you're going to have a bum tenant or it might take you longer than anticipated to get your place rented or something like that, where the cash flows are not going to be what you anticipated in the best case scenario. And you have to be prepared to weather that storm.
Come with it.
So just to interject too, and thank you so much for bringing that up to speak to the multifamily movement within the curriculum. Julian has laid things out so effortless for folks to build out cash reserves, for folks to have CapEx repairs, money that's already set aside. He gives you where you are establishing these bank accounts before you're even ready to purchase. And so the curriculum for multifamily movement members set you up for success. But for those who don't have access to the multifamily movement curriculum, I think your question is so valid and so poignant.
And I think Nikki, thank you for that, Lakeisha, and the mindset piece and making sure that you have, you're building your foundation on something solid, not quicksand. I think Nikki dropped some books, some publications in the chat for y'all to check out, so you can be ready and fortified. Like you said, when it rains, you don't need your rain boots and your raincoat. And if you caught without a
That's right.
raincoat or rain boots, and it start flooding, it's gonna be bad. So that's why we're here to keep each other accountable and say, hey, we need to round this out. We need to stand in the gap, close the gap. Um, Paula, no pressure, but anything to add to that question?
I think Nikki and Will covered it very well. So I don't really have very much to add to it. I will just say, there are options, these down payment assistance options that Nikki mentioned, and you always do have to have some skin in the game. You're going to have to bring something in, but you can minimize that by doing layered financing. I think that was what Nikki was alluding to. So it's basically if you have your mortgage, and then there might be a program like Cal HFA, which we can talk about that a little bit more later, but they might have an option where they allow you to have, they give you 3%, and then they might give you 2% so that you only have to come in with maybe 1%. So there's a lot of different options out there, but the most important part, again, is that you make sure that your foundation is good. Like Nikki mentioned, you don't want to just be like, okay, I scraped up that 1%. That's all I had in my bank account. And now here you go. That's not going to serve you well. You have to make sure that you have your savings and you have something to fall upon. If, for example, you lose your job or anything like that happens, you want to always make sure you have your reserves. So you don't want to go dumping all of your money into your property. But again, going to a housing counselor or even starting off with a loan officer to figure out where you are. They can, I always tell people, like, sorry, again, Nikki said this because I feel like everything that Nikki has said has been amazing. Some people think that they just aren't ready and they can't do it. There's no way that they can do it. Find out where you are. Go and speak to somebody so that you can see, okay, this is where I have to be. Maybe it's not going to happen tomorrow or next week or next month, but at least you know where you are and you can start to plan for that so that you are in a good position when the time comes to actually become a homeowner and stay a homeowner.
Ashe. And I see you. Thank you for that, Paula.
You're welcome.
Nikki, I know you had your hand up. Feel free to jump in.
So to kind of close out the conversation about down payment, which I didn't mention, but Paula stimulated the thought that some of these programs will be silent seconds, meaning not all down payment assistance is grants and free money. So you also need to understand what it is you're signing up for. And I don't say any of it is bad. You got to get in where you fit in, but you have to remember what you signed up for, because if you're not clear and you do get ready to sell or refi, you forget about that $25,000 down payment program that you're required to pay down. That's going to impact your equity, which then could impact, the wealth building and all the things that you're here to talk about. So be mindful of the programs that you are getting into, what is going to be the obligation. Some of those programs will say it doesn't matter when you sell, we want our money back. Some will say you stay in the property for X amount of years, you don't have to pay us back. So be really clear about what those requirements are.
Thank you for that. And Marcel, I do see your hand up. We're doing really good on time. I just have one second part to that question, but I'm gonna allow you, brother, please come off mic and answer a question, please.
Yeah, thanks, Ray. And maybe it was already answered. So I know earlier this week, Trump cut a lot of money, not all of it, but cut some funding for fair housing laws. How will that impact purchasing and all these different avenues if it potentially keeps happening, right, over and over a long time? What are the threats to that?
That's a good question.
I think the threats are consumer protections, because a lot of that define what lenders could and could not do, the fees and how they, approve different loans. So I think the protections of consumers will be eliminated. A part of that is CFPB, Consumer Finance Agency, is also under attack. So I think it's just going to be a matter of our protections being taken away on how people are able to, or how entities are able to do loans.
Yeah, I'd like to interject here as well.
Appreciate that answer. Thank you.
Sorry. I think another thing to consider is that if anything, the pandemic has highlighted is how fragmented our economy is. If you think about it statistically, like some 60 or so counties make up 50+% of all the economic output. So when you talk about things like fair housing implications, we're talking about this becomes a battle at the county level, right? Because they set these different rules, they set these different practices. Certain banks are only allowed to operate within certain regions. So then you have sort of this knock-on effect of certain lenders are actually going to be able to either basically fold under the pressure of this or try to find a way around it. So I think these are the things that I research and look into as well because um, at least in our community, this is not something they openly try to advertise to. Like, hey, here's how this policy is going to ruin your little hood. Like, that's never really talked about. So I would say, very to dovetail into what Nikki already outlined, there are these different tiered organizations at the federal congressional level, as well as some of these other executive branch levels that are being impacted that I feel like will ultimately start to play out at the regional level. So that's why things like what we're doing here is critical, is because at least we can start to coordinate within regions that we know we're not going to have as an intense of a battle to get those kind of funding. So I'll shut up there, but that's what I think of when we think about policy implication and think about like what does it mean for me? What does it mean for like my block? Like what can I do about that?
Yeah, I would like to add a little context to Marcel's question too. Um, so, Black people, the history of Black people, we have always had to operate in an environment of legislative hostility, shall we say. Redlining, which was commonplace for decades, the practice of like pigeonholing approving Black folks for loans only in like the Black neighborhood, certain areas like that. Recent research suggests that sort of permutations of redlining exist today. For instance, when Black people apply for higher end loans, they get denied at a higher rate than other people, even with similar credit. Even though their credit scores might be similar, or appraisals for Black people systematically come in below appraisals for white folks for very similar property types. So yeah, the legislative environment is probably going to become less favorable for us, but we have a rich legacy of achievement in spite of. So, whereas my prior commentary was maybe sounded a little pessimistic, this is where I get to offer a little optimism. We can do our thing regardless, and we have to resolve ourselves to overcoming these kinds of systematic obstacles and not letting that detract us from our big picture objectives. Get your money right, and ladies like Nikki and Paula, they'll find a way.
I
Real
appreciate
quick,
that.
love that. And selfishly, just to kind of parallel like my vicissitudes, my challenges that I had in the world of finance before I, start dabbling in public service. Um, I had gave you kudos, Will and Nikki. I know same thing because you were in wealth management and finance. Is you showing up the way that you are, Will, being authentic. Brother got the locks. Uh, you know, I think you've been rocking in finance since like the late 90s and maybe prior to that. I think that parallels to what you're talking about is navigating these waters in a way that is true to us, but also we understand that how we have to show up and what the systematic barriers are.
Hey,
So
Ray, I just want to just follow up on all that was said. And I learned so much from each person's comment and really just, the threat of it, right? And I love how Will just finished it up, right? Yeah, those measures are there in practice, because, back in the day, it was more impactful. We have other resources, right? I think what we should be aware of as we see these marginalized or small cuts, how it impacts ownership, and I think so that I love what Marcus DeMarcus said. He says, this is why we're here to activate, right? This is why we have these conversations, to be ahead of that. And that's what Malcolm said. Yeah, to be ahead of that so that as we're watching this, we are able to be impactful because we need more support on the front end of things. And never to be pessimistic, but realizing there is a solution, but bringing our collective minds together. I'm appreciating all the comments. And okay, I'm bowing out, Ray. Thank you, sir. Thank you.
Thank you. Appreciate you, Marcel. And we're at 12:20. So we got one more time. So we're doing good on time, y'all. Love this. So part two to that question, it was partly answered. I think it might have been adequately answered, but I'd be remiss if I didn't ask it. What strategies can buyers use post-acquisition, such as refinancing or using rental income to qualify for additional loans? Or is this a no-no, especially in this environment, this backdrop, as we discussed earlier?
I think keeping the same behaviors, because what we find is people get so excited they got the home and then they revert right back to what they were doing that made it so challenging for them to get the home. So you can't forget that you still have to manage debt. You still have to manage your, cash management. Because again, we know with real estate, interest rates you can't predict. So right now we're at, 6 and some 7%. We had a client came in the other day at a 9% interest rate. Sounds high because most of us have been in an environment with very low interest rates, but back in the late 90s or even further back, it was 12 or 13%. So this is nothing new. But if you're getting into the market right now at higher interest rates, when those interest rates fall, or you want to take equity out to do all the things that we were told this was supposed to do, you have to be ready. And as they say, if you stay ready, you ain't got to get ready. So maintaining high credit scores, low debt, significant cash savings, so that when you need to move and pivot, you can. Because the other thing about our history is that they say when others get a cold, we get a flu. So regardless of how prepared we are, it is going to be more impactful. So we can't do what others do because we don't have the grace, we don't have the luxury. So you have to be even tighter with the disciplines.
I just got to jump in there. Thank you so much, Nikki, because what came to mind is we need to have a vision for what it is that we want to do, right? And so thinking about a year goal, a 5-year goal, a 10-year goal, a 20-year goal, how are we planning in our minds to succeed? And I'm thinking now, like creating a scalability profile, thinking about now, because to your point, Nikki, we were like, know what, like one, you have to have the foundation. Two, don't put the cart before the horse, but plan. I think if we're more planning for our success, we're more motivated to move and to keep those habits and those behaviors that were established in order to get us that first property will be what we need to sustain us moving forward into our second, third. Some people have the desire to have a large portfolio. Some people have a desire to have a small portfolio. Some people only want to have one property. So I think just knowing who you are and what you want specifically, individually for your future, establish that, and then create your vision, create your goals. A year from now, 5 years from now, I want to be on my second property. I want to add 2 more properties to my portfolio. But I think understanding where you want to be in the long run is what we have need of to propel us again into our future. I'm big about writing a vision. I'm big about setting goals. I'm big about forecasting, looking forward, predicting. What do I want? I'm a mother. I have 6 children. I want generational wealth for 5 generations. That's what I want. Some people are not thinking that far. Some people not even worried about none of that. But that's what I'm thinking about. So just wanted to share that little piece.
100%. I appreciate that, sis. Love it.
I'll jump in and just, to address the question of taking money out of your property to buy another property. That's not a no-no at all. People do that. That's how they start to build their own wealth through real estate. But again, to the points that have been made, you have to plan that and you have to make sure you have a tight foundation before you do that. You don't want to willy-nilly start pulling money out to buy other property without any kind of a plan, any kind of structure. I honestly, with my clients, I'm always encouraging people to build wealth through real estate. And I always give them recommendations for financial planners that we can all work together so that they can see when they're ready to do that. Because you may not exactly know when you're ready. It's like not everybody is savvy about exactly when they're ready. So you might need some help figuring that out. And I like to work with their financial planners to see what we can do. So it's, for one, figuring out if you're going to be able to afford to take that out, because now if you take that money out of your property, your mortgage payment is going to go up. So you need to be sure that you can cover that new mortgage payment when you go to buy this other property. Then you have this new property. You need to make sure you have reserves, like Will was talking about earlier, and Nikki, to make sure you have enough reserves in case you don't get a tenant right away, or your tenant leaves and you don't have a new tenant for 6 months, or your tenant's not paying rent for 6 months. So all of those things are going to be important in you deciding if you're going to pull equity out of your property to buy another property. Another thing I wanted to mention, just going back to FHA loans, FHA loans have something called, and Nikki might have mentioned this before I jumped on, but they have mortgage insurance. There's upfront mortgage insurance premium that has to be paid at the time of closing. It comes out of it gets added to the loan. So you're not paying it up front, but it has to be paid at that time. And then there's also monthly mortgage insurance. And this is just, a way of protecting against default, because they are allowing you to come in with less money down. So they have to be able to have a way of protecting in case you do default. So the reason I'm bringing this up is because FHA is great for people trying to get into property, first-time home buyers. Maybe they have some challenges with credit, low down payment, et cetera. But you don't want to stay in an FHA loan forever because you're paying this mortgage insurance premium every single month. So eventually, before you start thinking about, or maybe at the time that you're thinking about trying to take equity out, you also want to refinance out of an FHA mortgage as soon as possible. And the ways that you do that, you can get refinance into a regular conventional mortgage. I won't go into too many details about this because it'll probably get hairy, and I'm happy to talk about more later. But you're really wanting to do that to either reduce the interest rate. You might want to be pulling money out, but you also want to get rid of that mortgage insurance. And in order to do that, you have to have a loan to value of 80%. So for example, if you come in FHA and you put down 3.5%, your loan to value is 96.5%, right? The difference between 100 and 3.5. So in order for you to get rid of mortgage insurance, you have to have a loan to value of 80%. So that, we're lucky here because properties appreciate pretty quickly. And so in a year or two, you might be at that 80% and you're straight. And so now you can refinance into a conventional mortgage without the mortgage insurance. But you definitely don't want to be looking at, well, in my opinion, if you have FHA loan, you don't want to refinance and get another FHA loan and then buy a property because you already have this mortgage insurance you're dealing with. Get that cleaned up first, get out of the FHA loan and get into a conventional mortgage. And then you can pull out some money to buy another property. And sometimes, you might already be in a conventional loan and you have a great interest rate. You can get a home equity line of credit. It's a line of credit which is behind your mortgage so that you can pull the money out to buy another property, and then you don't touch your first mortgage that might have a really good interest rate. So those are my little tidbits on buying another piece of property.
What I would say is, so in general, I think I'm probably pretty receptive to the idea of using equity in a property to to acquire more appreciating assets. I think it makes great sense, generally speaking, because, all right, so on the one hand, there's a case to be made that we should not expect over the next decade or so, we should not expect real estate prices to appreciate like they have over the last 10, 20 years. There's the Federal Reserve Bank of Dallas, they published a paper last year suggesting that home prices are 20% overvalued. When you look at stock prices of public landlords, they discount net asset values, which is just a fancy way of saying that the stock market thinks that prices are overvalued to the tune of somewhere between 20 and 35%. When you look at price to rent ratios and other objective measures, the story is kind of consistent that home prices look expensive relative to intrinsic value and relative to long-term norms. So maybe we should temper our expectations for home price growth going forward. But even if there is a correction at some point, one of the benefits of acquiring properties sooner than later is that eventually they'll be paid off, and then whatever the rent is going to be just pure net income to you with no expense. So, generally speaking, I would be receptive. I would advocate that kind of thinking. But to Nikki and Paula's point, you have to be ready. You have to do the work either alone or in concert with other professionals to make sure that you're evaluating the interest rate environment, the rate of the new loan, the impact of of taking equity out of your existing properties, and make sure that your cash flows can sustain this change in your balance sheet.
That's a perfect actually segue, but I did want to also kind of talk about the interest rate environment and what it has been historically and how we have still in interest rate environments where it was 18% have been able to prevail. So no way do we want interest rates. And we, Lakeisha and I, we also work with a real estate brokerage where the common thing will come up is like, why should I buy a home now? The interest rates are high. Well, that's relative, right? And then Will in the chat kind of talked about, well, interest rates were once at 18%. Remember, y'all, and like Lakeisha was saying, you have a purpose, you have a mission. And like Paula was saying, is that look, you can wait 6 months, I think 6 months or to a year in some loans, I think 6 months, right? To refinance out of that loan if the interest rate environment does change. Do I think we're going to get to historical lows like we did within the past, like, who was it, 5, 10 years? Probably not. But remember, if it is at an 8%, you can go back and refi once the feds do some cutting. And now this Federal Reserve now, given the federal administration we have now in the executive branch, it's a lot going on. So I think, and I know they're independent, but we may see cuts. So I would say be optimistic and just move forward with what we got. We've been making, lemon meringue pie out of lemons and lemonade. So we'll continue that legacy. Um,
Absolutely. Absolutely, Ray. I would say, yeah, 'cause that's another question that comes up all the time. Is now a good time to buy? It is if you're buying something you can afford now. Because again, eventually, if you buy now, you buy a property that you can afford that's within your means now, eventually it's going to be paid off. 30 years from now is going to, or perhaps sooner, it'll be paid off. And then all of that income, then the overhead goes way down. Your net income increases dramatically. So that's the benefit of moving sooner than later. Yeah. In 1981, the average 30-year mortgage fixed rate mortgage peaked at 18.44. So, here we are, 6, 7, 8% that we've seen in recent years. And people think that, a 2.5 mortgage is their God-given right. Not necessarily. In fact, my view, I've studied interest rate cycles and asset class price cycles for over the last 150 years. My view is that we're never in our lifetimes going to see rates as cheap as that low that we hit in 2020. So for those of us who have those 2020 mortgages, my counsel is always to never refinance those. Don't prepay them. Don't pay them off early. Take your time and pay those things off over the next 25 years or whatever. And then, we deal with the new environment as it is, not as we hope it will be. So if you can't afford to take on the expense of adding properties now, then yes, it is a good time. If the cash flows make sense, yes, it is a good time in spite of high interest rates or higher interest rates.
Really quick, I just got to jump in because I got to give a shout out to my mother, Linda Hughes, who made her transition in 2022. In 2020, that lady refinanced her house to a 2.5 interest rate. And guess what? My brother and I inherited her property. We did not change the loan terms. And I'm so grateful. So yes, do not change any loan terms. Thank you, Will, for saying that. Thank you, Linda. I love you and I miss you.
Love you, Linda. Miss Nikki, Miss Beasley.
Yes, so I think this is also a good opportunity to start thinking about. I know this conversation is focused on building wealth through real estate, However, wealthy people have a number of different vehicles in which they're accumulating wealth so that when the market is down, they're, reaching out to their retirement. When that retirement is down, they're going to the real estate. So the goal would also being having a very diverse portfolio, not just in your rental, but all aspects of investment. So regardless of what's going on in the environment, and I'm thinking more on, because I'm in that cycle now of thinking about retirement, of understanding where you can pull money from regardless of what's going on in the market. And something that came up yesterday, I had the opportunity to sit down with two significant developers in the Bay Area, two Black women, one by the name of Deidre Harris, who is considered an emerging developer, just got $10 million out of Oakland to do a project in Oakland. And then Charmaine Curtis, who has one of the largest projects in San Francisco, China Basin. And one thing that came up was property management. So there's also a lot of vehicles in real estate. It's not just buying and selling real estate, but what is the business of real estate? Right now, there is little or no strong property management firms that are taking care of the people that we care about. So if you want to be in the real estate business, think about property management because it's great to have all these assets, but someone needs to manage it. And if you are good in the transactional arm, but not good in the administration and management arm, you may look to a property manager. So look into that work because there's not enough of us doing that work to any large scale. The other thing to also think about is the asset management piece, because again, it's one great thing to have all these properties, but managing the loan notes, managing the deferred maintenance, and all the things that are going to be required depending on the level or scale of your rental portfolio does open up other business options in managing real estate.
Talk about that. Talk about that. Um, I see your hand, Marcel. I was going to segue to our wealth building segment. If you want to quickly add something, did you have something you want to add?
I mean, it really was a response. I love how she segued over to other industries because someone made the point earlier about how we pay extra for points, right? As like overall as a group, we do. So I've had the pleasure to be in both the auto industry and a little brief real estate, yes, in commercial real estate, a junior agent. I would say in the auto industry, I've seen folks who look at scores and will pay points. So be careful of this outside of the real estate industry, as car is the second biggest asset you'll purchase. Be mindful of that. In ways you combat that is bringing your own financing. Don't believe them when they say it, that they have it unless it's from the manufacturer. Go to your bank, come with your own money, particularly women. Women pay more. I'm going to say that. And in my position, being in that kind of industry, our position completely different. I'm very transparent and would never do business like that. But it was a common practice that I did come across. And I advocated when I saw it. I want that to be heard as well. Thanks, Ray.
That's a heavy factor. No, thank you. Like you said, second to real estate is car purchasing, vehicle purchasing, and you pay that over a period of time, 5 years, whatever, however many years, and you don't want to give them more money than what they need. You need that money in your pocket. So thank you for mentioning that. And I'm thinking this has got to be. This is not. I don't know if it's just sheer happenstance, it just happened this way, but we're actually going into the segment about wealth building outside of real estate, who our expert Will, who will speak on, and Will, coming straight at you, brother.
Yes, sir. Nikki gave me a beautiful slow pitch here talking about
Love it.
diversification strategies. And I think this gets to the heart of why Ray brought me on this panel with you very knowledgeable ladies with this very detailed and specific expertise in the realm of real estate. That was spot on, Nikki. Very wealthy people, they have a variety. They have exposure to a variety of asset classes, real estate being one of them. Black people tend to gravitate towards real estate, I think largely out of a educational sort of divide, disparate education between, for most of us, we didn't have fathers who sat at the table reading the Wall Street Journal every day, like many of my clients did, or fathers who talked to them about stock ownership and left them, massive equity portfolios, like many of my clients did. However, it's important that we understand that, real estate has been a great means of wealth accumulation for Black people. It's not the only way. In fact, few years back, there were some researchers out of UC Davis and University of Bonn and a couple other places doing this paper for the Federal Reserve Bank of San Francisco. They looked at asset class returns for stocks and bonds and real estates and short-term bills and other financial and non-financial assets from essentially 1870 to 2015. So 135 years of data. And over that time frame in the United States, they found this the stock market has been, bar none, the biggest wealth creator that we have at our disposal. So, not to mention the rate of return being superior to real estate by, I think, is like close to 2.5% a year on average. Also, the stock market is the biggest market, investable asset market in our country, is like 3 times the size of the real estate market. And there are other benefits too, liquidity being one. So if you own a stock portfolio and you need money, you theoretically could sell your stock on Monday and have the cash in hand on Tuesday. Unlike in real estate, where there's a process. You got to find your agent, maybe stage the property, show it, ultimately accept an offer. Then there's the escrow process, and so it's a very timely ordeal. So for all of those reasons, I think we as investors, as folks committed to building generational wealth, we need to. I'm an advocate of real estate. My position now is to increase my exposure to investment real estate, but that's not the only thing I own. I also have a pretty robust equity market portfolio. For those reasons, because that has been the biggest wealth creator known to man, and the rate of return has been higher. So we do need to think about other asset classes that complement real estate. So there was this cat named Harry Markowitz 70 years ago in the early 1950s, and he was the one that floated this notion that, okay, if you have one investment asset, you actually could reduce your risk by adding another investment asset that has a positive rate of return over time, as long as the two things are not driven by the same thing. And that's the case actually with real estate and stock. The drivers are different. And so by combining the two, you get positive long-term growth and you reduce the volatility. So I am very much an advocate of obviously sort of the stock market is the pool that I splash in. So I think it makes great sense to marry the two asset classes, at least those two. There's a place for fixed income, there's a place for alternative investment strategies, but the stock market is extremely accessible. Another benefit of the stock market, an endearing quality of the stock market relative to real estate, is the capacity for incrementalism. A couple of $10 words, but what I mean by that is that with real estate, you might need 3.5% for an FHA loan, or you got to have some money. For stock market, you can start investing in a diversified basket of stocks with $50 a month, $100 a month, whatever it is. You don't have to have tens of thousands or hundreds of thousands of dollars to get into the stock market. Now, it's important that we understand the risks, because investing in any particular asset class has some very specific risks, and we have to understand the game. A bunch of my friends tried day trading, for instance, during the COVID era, and they lost money, which is not unexpected because most traders lose money. But they came to the conclusion, oh, the market is rigged, the little man can't win. And me, I mean, in my heart, I'm always going to be a poor kid from Compton, regardless of how much success I achieve. I'm like, Little man can win. Little man got to know the rules of the game, though, and play accordingly. So one of the things that I like to do, and I don't want to take up too much time, but one of the things I like to do for my Black people especially is to make sure that we understand the rules of the game. And so that we go into it with our eyes wide open, we know what to expect and we know how to succeed. But I think it makes great sense to expand our horizons beyond real estate. Real estate is a great first foray into wealth building, but that shouldn't be the end all be all. We start building our real estate portfolio, and then maybe when the cash flows turn positive and we're getting incremental income monthly, then we use that to start to build our equity portfolio, and we round out a diversified basket of assets that are going to serve us well through retirement, and eventually we're going to leave this stuff to our kids and our kids' kids.
I love it. I love it. Nikki, I wanted to pose a question, but I'm going to do it after I hear from you because I know you have something to add to this as well
Yeah.
because of your background.
So I'm taking space because I am now and definitely appreciating being an elder. So when I pop in, know that I'm just sharing wisdom.
Please.
So to Will's point, you only lose in investments when you sell. So a loss
Mhm.
is a paper loss until you sell. So when you think about '08, the market crash as far as homes were concerned, people took that as I'm never going to purchase another home, or I'm not going to purchase a home because I saw what happened to my mom and dad when they lost their home. The only time that that was a loss is if they had to sell the property. You bought it at 300, it's now 150, and you have to get out of the transaction. You don't get the benefit of the equity. But those that held were able to hold on to their homes. Now those property values are five, six, seven, $800,000, depending on where you purchase. So it's only the sell. The same with investments. I'm not going to invest because my mom and dad lost their retirement, and whenever the last market crash was. There was only a loss if they needed to take money out for their retirement. So when you're thinking about investment, it really is based on your life cycle. And if you're like me, almost 60 years old, no, I'm not going to be just in stocks. I need to have a well-diverse portfolio to be able to help mitigate the risk. But if you're in your 20s, you can get very aggressive. I share a funny story that we're all going to fall. Falling at 20, you're a lot more resilient. Falling at 30, you're a lot more resilient. But when you get to almost 60, you're not that resilient. You fall and be like, hold up, don't touch me. Let me think through how I'm going to get up. Or we're going to do everything we can so that we don't fall. Because if we fall now, we're going to hurt something really bad. So understand life cycle. Understand that when you get into investments, understand the rules. This ain't the money that you put in your savings account. You put it in one day and you got to take it out the next because you don't have a reserve. This is money that you put away that you can forget about and know that it's there to do its work. Don't look at your statements every month. Well, now it's up, now it's down. Don't have that emotional roller coaster. And understand when you get into the business of investment, you're playing now with the big boys. So you have to understand what it's supposed to do and what it's not going to do. And the only time it becomes a loss is when you need the money and it's not where you thought it would be.
100%. All facts. Factimonials. Um, Thank you for that, Miss Beasley. I did want to, a lot of the questions that I'm looking through were answered through the process just by this natural occurrence. So I'm really appreciative of that. But I do have one question, and this is really for the audience. And you talked about it a little bit, Will, and anybody can speak to this. If you have experience, you can speak to it. But jumping it off with Will, how should investors balance short-term cash flow and versus long-term wealth creation in multifamily real estate?
Yeah. So again, I'm going to speak from a generalist perspective, and I'll defer to Nikki and Paula to talk more specifically about real estate. But and I think we probably have beat this horse somewhat. But we have to look at our cash, be honest, brutally honest with ourselves with regard to our cash flows, the money that's coming in from our primary employment income, our passive income from our real estate ventures, and the money that's going out in terms of our consumption habits and needs, as well as our fixed expenses. And we have to have enough to cover. The rule of thumb is 6 to 12 months. The traditional rule of thumb is 6 to 12 months. In case it all goes bad, you lose your job and your tenants are bums. You got to be able to weather the storm for 6 to 12 months. There's actually some new research that suggests a year to 2 years, but conventional wisdom has been like 6 to 12 months of reserves to get you through a worst case scenario kind of environment. Once you have that nest egg in place, considering all of your the money coming in and the money going out on a periodic basis, then that excess, that's what you have to commit to long-term wealth building strategies.
Awesome. Awesome. I'm gonna get to because I know you give me some tips and some game on investing in equities. If you have 50, if someone had $50,000 to invest today, what would be your recommended first steps to get started? And I know you have the disclaimer. This is not what is it, financial advice, but this
Right.
is so if you want to add that disclaimer, understand y'all, this is not financial advice. This is hypothetical.
Yeah, so for a new investor, I would say probably just buy like a fund that gives you a basket of stocks, something that's going to a vehicle that's going to give you exposure to the whole market rather than trying to pick the next Nvidia or the next hot stock. There's a cat, and so I'm a finance nerd, so I spend a lot of time just like digesting new research. The new academic research has been where other academics have kicked the tires, has been peer reviewed and held up to scrutiny. So there's this cat named out of Arizona State University, Hendrik Bessenbinder. In 2017, he published his comprehensive review. He looked at essentially every stock that ever traded on a U.S. exchange from 1926 to 2015. I think it's been updated more recently. It's like 26,000 stocks. And what he found is that most of them over their lifetime lost money. So what I take away from that exercise is that it's very, very difficult. Talk about a needle in a haystack kind of stuff to try to pick that next stock that's going to shoot the moon. But what we know with a high degree of confidence is if you buy a basket of stocks that represents the whole market, and there are very accessible baskets that you can put $100 in every month or $50 every pay period or whatever fits your budget. You can do that periodically and stick with it. Then you will achieve the market return. I remember when I started at Morgan Stanley as a young man contributing to the 401k. I just set up my allocation and as Nikki said, I wasn't fussing over it every month. Now I was broke. I was just out of college, starving student. I think I was making at the time like 24 grand a year, living in San Francisco in the late 1990s. So I really was broke. But I resolved to put away. I don't remember what it was. It was a small, tiny number. Put it away every pay period though, and then a couple years. I didn't look at my statements maybe for a couple years. A few years later, I finally opened up a statement, and I was stunned at power of compound growth. So that would be my advice for new investors is don't be swayed by these stories we're gonna see on Instagram, people talking about day trading cryptocurrencies and all this kind of stuff, or meme stocks like AMC and GameStop and all this kind of stuff. A lot of that's not real life. If you buy a basket of stocks that represents the market and you put money into it very consistently over a long period of time, you will average over long periods of time, you'll average about 10% a year. I tell my son and kids his age, it's not difficult to save $1 million. It requires discipline, but mechanically is not difficult. All you gotta do is put $150,000, or excuse me, $150 a month away between age 18 and 65 and put that in the market. And that's $1 million at age 65. So, mechanically is not difficult to build wealth. It requires discipline, but mechanically it's easy.
Come on. Come on. Look, I don't even think I need to read the rest of the questions, man, because you just covered that in just that master class. You just succinctly uh just broke it down, the fundamentals, right? But if you want to slip some good stocks from that you've been sitting on, man, and you no, I'm just kidding. But feel free to if you want to. Miss Beasley, I see you got your hand up, please.
Will, are you in position to talk about how insurance can also be a part of an investment strategy?
Yes. So for me, I do not regard insurance as an investment product. Insurance absolutely has a purpose, but I draw a distinction between insurance and investment products. Now, so if the objective is to build wealth, then that's when we're talking about real estate and stocks and those kinds of asset classes that have historically served that purpose. The purpose of real estate, in my thinking, is to control for various risks. So, like for instance, if my wife and I buy a house, we take out a 30-year fixed rate mortgage. Hypothetically, my wife actually makes a lot of money, but let's say hypothetically, I'm the breadwinner. We take out this mortgage. I might buy a term insurance policy so that if I walk outside and get hit by a bus, my wife will have the money to pay off the mortgage, that kind of a thing. I think insurance or long-term care insurance when you're young might make sense because those last few years of life tend to be notoriously expensive. So I use insurance specifically to address those kinds of risks and not as an investment product.
Thank
I
you.
know there are like
Yeah.
universal life policies and all this kind of stuff that purportedly have investment qualities. However, the research suggests that you pretty much almost always be better off by just buying a term policy, which will have a lower premium and taking the difference and investing it in the market over a long period of time.
Yeah. Well, I would suggest you just in the investment strategy. For those that may have $1 that needs to do many different things, because you're hearing about real estate, investing in real estate, putting money in an investment. There's also this thing that's the reality thing called death. And from a wealth transfer standpoint, we don't do a very good job of planning for the ultimate death conversations, which we really have a hard time talking about. So when you're talking through what's the best investment strategy for you, when you're, looking at the professionals, find those that can give you all the different options so that you can make a good distinction. Because insurance can also be something that for more of a supplemental retirement strategy, again, going back to the number of buckets that you may want to pull from, and it's multitasking. So just know that that's an opportunity of conversation. And one thing I will mention from a wealth transfer standpoint, RNHS created something called the Protect Your Legacy program, where we're supporting seniors in Alameda, Contra Costa, and Solano County. That if you're a senior, low income, own a home, and do not have a living trust, we're paying for that.
Oh,
Because we
wow.
also know that that is the ultimate tool needed to transfer the wealth appropriately when one passes. So if you know an elder or you are an elder living in one of those counties, own a home, and meet the low income requirements, please make sure that you reach out to me so that we can assist in building that living trust. And we're working with attorneys. We're not doing it, but it takes you from soups to nuts the through the recording with the county. So it's a full service proposition.
I
Nikki,
really
I feel like
appreciate
we
that.
might be psychically linked because it's like the topics that I want to cover is like you set them up so perfectly. So that is actually the last thing that I wanted that I wanted to talk about, and then I'm gonna shut up, Ray. But yeah, so we talked about like the psychology of wealth building, putting ourselves in a mindset to where wealth building is really a priority in our and adjusting our actions accordingly. We talked about some specific strategies, whether it's investment in multifamily real estate or other asset classes. I think the other thing, since the topic of this conversation is a generational wealth building and transfer, the last part is efficiently moving the assets from ourselves to future generations, and a living trust is the best way to do that. What a living trust is, a trust document, it's a document essentially that says what you want to happen upon your incapacitation or upon your demise. And you can be very, very specific. Like, for instance, I don't want my kids to sell my real estate. So, in my trust document, it says, you guys can live in it, you can rent it out and take the money. You cannot sell it. That kind of thing. It says who gets what and how much, under what circumstances, all these kinds of things. And the reason, distinctions from a will is that a will is public. If I die and I have a will, anybody can pull a copy of my will and be like, oh, he had this. Oh, his kids got money. Let me hit them up and pitch them this business plan I got. We're gonna open some weed clubs or whatever. Whereas a trust document is totally private. Nobody's gonna know about that except the lawyer and the beneficiaries. Also, a trust document, you avoid probate. Which is this costly process after somebody dies, where the court has to come in and administer the distribution of their assets. And of course, the court ain't gonna do this for free. They're gonna take a cut. California actually is one of the more expensive and time-consuming probate processes around the country. Every state has their own deal with regard to probate. California is one of the more expensive. So by having a living trust, you avoid probate too. So that's something that's sort of the third aspect that we need to orient ourselves around. And Nikki's agency. For older people, they're doing that for free, but there are ways. There are like online, to the extent that our estate is fairly simple at this point. We have like, a couple or a few investment accounts and a couple or a few real properties that we own. There are mediums online where you could have a trust drawn up for 150, couple $100. So that's something that I recommend that we start to, that we don't wait until we're 50 or 60 to do, because you never know what's going to happen. I know, there are people, Prince, Aretha Franklin, what's my Chadwick Boseman. These guys all died without having their estate planning in order. And they had real money, right? Prince had like 6 half siblings, and to this they still fighting over his money.
I was
Aretha
just about to
Franklin, she
say.
had one special needs, one of her children's special needs, and so they like trying to figure out like what part of the pie is supposed to go to support that kid, and whose responsibility it is. So we can stave off all of these potential conflicts, all these family controversies, because that's another thing. Black families, you put a little money in the mix, people tend to go kind of crazy. So we can stave all this stuff off by thorough estate planning efforts. So, all right, I'm
That
done.
might be the next one. We might need to invite you back. Well,
Absolutely.
if you open to it. I do want to
Absolutely.
be respectful of y'all's time, our audience's time, because we're about 2 minutes from the mark, and I wanted to leave time. Well, I just want to give special thanks to the panel. Not to say we disperse now, but I wanted to give light to any questions our audience members might have. Because I did say I was going to leave time for our audience members, our family here, to ask any questions. Anybody want to come off mic or go ahead and put into the chat a question you may have.
When is our next session? I got my notes and my pen ready to go.
I'm glad you ready to go. Well, we're gonna have it was the first Saturdays of each month. That's what we plan to. But if we need to flex it a bit, I'm hoping we'll be amenable to that, to have guests like we have today, if their schedules don't permit it to
In
be.
addition, we want to schedule time to meet with folks also in person. Our initial groups were held every first, second Saturday in person at Kim Folks. Then we pivoted to Zoom. So we want to schedule some time to touch, hold, hug, see people in person.
Absolutely. And everyone who, to Lakeisha's point, everyone who submitted their information through the invite, I know some folks, I just dropped the link because I know I had to approve you to get in. So I apologize for that delay. We want to get your information so you stay abreast of these events as they come up. Thank you again. So yeah, the Synergy form was just dropped once more. Copy, paste it, put it in your browser so you have it to go back to once this is over. But I do. If no one has any questions, I do want to give special. Oh, Paula put her email in there. Nikki put her email in there. So I'm going to leave the meeting open for about the next 5-10 minutes to make sure that y'all grab that information and can contact these folks because they're a wealth of wisdom and a huge value. to us and to our community. So with that, thank you, Nikki, Will, Paula, for sharing your. I know you probably looking at some assets on the other screen, Will, but no, I appreciate you. We truly appreciate you coming in and gracing us with your presence. Thank
You're
you.
most welcome. Thank you for having me.
And we also just appreciate the work that you all are doing to transform the lives of not only the folks you work with, but our folks. And so, thank you, Nikki. Thank you, Will. Thank you, Paula, for contributing to our lives. And we are super excited to build sustainable relationships, sustainable networking opportunities that we bring forth a mighty power in the Bay Area. Looking forward to seeing how things move forward for us as a collective.
Thank you all for having me. It's my great pleasure.
Thank you. I'm gonna just feel free, panelists, to bow out gracefully if you need to, but I'm gonna just leave this open just in case anybody wants to capture your information. I see you just dropped your email, Will, so
Yes,
I'm just
sir.
gonna leave that open just in case anybody wants to capture that. But please, even our panelists, please fill out that synergy form because we might have folks that will seek you out based on your experience and based on the value you bring.
All right, everybody, have a good day. Thanks
You
again.
too. Black Ops team, we're gonna debrief. Black
Yes,
Ops
yes,
debrief.
that's right. All right, y'all. Have a good one. Thank y'all. I'm gonna use the restroom, y'all. I'll be right back. All right. Um, Jennifer, you still there? She might have stepped away.
You want to drop her in the?
Yeah, I could put because she might be I like that feature. All right. Whew.
Okay.
Oh, did I stop the recording? Are we gonna start?
Oh, yeah.